Thank you, everyone, for joining our first Landowner Insights webinar here in 2025. We wanted to talk a little bit about some of the data and some of the interesting perspectives that have emerged as we go here into 2025 and kind of what that's showing us and what we're planning on within the land market. And we've put out quite a bit of information going back to the National Land Values Report that came out here towards the end of the year, and then of course through the expo. And so some of that information will get merged in here, and then we're going to talk just a little bit of a higher level perspective on what we think it means and where's that hitting some opportunities, and certainly a little bit of a focus on what's kind of things looking like for farm income in 2025. Clearly a topic at hand. So first thing that we want to jump into is just giving that update on People's Company. As many folks know, we've completed several acquisitions, particularly in the land management space, and expanded offices across Nebraska and Iowa and Illinois. And it's been really exciting. 2024 was a great year for the company in terms of helping grow that footprint and be able to provide additional services and expand our offerings within several regions here in the country. And so we are full service, we are national scale, and that means that we're going to be able to help landowners with any of the sort of core functions, core service needs that they need at their fingertips relative to their farmland assets across the country. And so let's start looking just a little bit at the market trends and what's really happened. So the asset class has jumped up over $4 trillion in total here in 2024. That's still forecasted. There's a few things coming together from the data. And the growth in the asset class has been really quite impressive. We're going back to 1970 here. We can see interesting blips through 1980, drop back, and then we've had our consistent growth, and leverage has continued to come down. So we're right in that range of 13% levered as a total of that $4.3 trillion in value, a little under. And just a little bit of perspective, if we look at the Federal Reserve's numbers, they've got farmland pegged at about 3.5 trillion. The difference there is a little bit of characterization of rangeland across the country. And just to give some perspective, right, commercial real estate, which is sort of the key kind of real asset that we see a lot of investment interested in, is just under 22 trillion. So we're a real asset class, and we're garnering a lot of interest from the investment community as we continue to grow the value in the asset class. And the returns are strong, right? So again, the National Land Values Report will give some really great data looking at this regionally, breaking this down, a little bit of perspective, right? So if we look at farmland in total, so we call that the U.S. Ag 32 states. It's the 32 states that really matter for the asset class. Right about 9% total return. This is going back to 1991. With very little volatility, very minimal risk of negative returns. When we start to look at some of the key states, we see double-digit returns. Iowa, Washington, Oregon. There's several states that are going to be in that long-term double-digit category. And that's really competitive when we get down here and look at some of the public equities, S&P 500, NASDAQ. The key being is we don't have these massive equity drawdowns that you can see in these public equities. So we're uncorrelated, not correlated with public equities, and tightly correlated with inflation. And that trend has continued. We'll look at that just a little bit to grab a little bit more context here. So the farmland values, and of course, when we look at these numbers by state, they're going to feel a little bit light because this is an aggregated USDA number in terms of representing all the land in a particular state. The total return for 2024, what we start to see is there's a lot of numbers on the board here that are going to be lower than that long-term average that we just looked at. And I think everybody's feeling that in the marketplace in the context of a little bit of a pullback, particularly in parts of the Corn Belt in the Midwest. And then there's some real pressures in other parts of the country that can be tied to specific crops and production systems. And so that's a theme coming out of 2024 that's interesting as we look into 2025 and think about what's happening with the income. So year-on-year value change points you to Iowa and Illinois here, 3 and 4%. That's significantly less than that 7 to 8% that we see over the long-term average. And we're still seeing some of these value adds sort of around the core Corn Belt. There tends to be a little bit of a time delay. And the other thing we note when we look at these numbers, it's a lot of USDA reporting, that's survey data, that's going to be collected towards the beginning of the year, and then procured, the data worked over, and then ultimately rolled out in roughly August. So there's a lag in a lot of these data sets. And I think folks that have been active in the land community understand that there's certainly opportunities to get land acquired at prices a little bit lower than where we had seen previously. And again, that's an interesting trend looking forward. Now, if we look at what's happened in this inflationary period starting in 2020, we see some really impressive runs in land. Kansas really jumps out here. There's some interesting dynamics in Kansas. We kind of had been feeling like there was some negativity, particularly related to water in Kansas. And that'll be a topic thinking about the Ogallala and is it actually investable that we'll be tackling over the first couple quarters of this year and rolling out a white paper for folks that are interested in that. We've done a deep dive there and had an initial presentation of some data in a breakout session at the Land Expo, if folks are interested in that. And we'll be continuing to develop that particular perspective going forward as well. But what we've seen is this strong pattern, this correlation with inflation over this latest run. This graph is always really interesting to look at. We've got the aggregate US Ag 32 states returns by year, and then it's the spread over CPI. And what we see is that fairly consistent pattern averaging about 6% over this long period of time. And this latest inflationary period, we've seen a very clear trend following. Now, with that said, one of the things that we really need to pay attention to when we're working with capital partners or working with landowners and thinking about farmland as that inflation hedge real asset is not all production systems operate quite the same relative to inflation. So what we're looking at here is CPI over a period going back to 1996 through 2023. And then we've lined up a few states with pretty different characteristics. Iowa representing that sort of core commodity production. We've got California, which is incredibly diverse production system, highly dependent on water, and then a number of different regulatory pressures in there. And on the row crop side, really high value fresh market production. And we've got Washington State, which also represents really diverse production ranging from dryland wheat all the way through to valuable apples and the row crop fresh market production in between. So we do see some interesting characteristics. So Iowa tends to be very reactive in these inflationary trends, and it's reactive in terms of the commodity price environment. The other characteristic that we've got within these states that we'll talk about just a little bit more is the ownership dynamics. Iowa, of course, having much higher percentage of owner operators. And so that cash flow from the farm operations is very impactful to how the buyers of farmland can engage the asset class as we move through time. And we tend to see those patterns and that reactivity jump out. California is less reactive to some of the inflationary trends. And that's an important note when we think about deploying capital, particularly where the thesis is around farmland as an inflation hedge. We do still see those characteristics across all states and certainly in the aggregate, as we saw in the last graphic. Another perspective on this is just thinking about a couple of commodities. So in this case, we're looking at CPI and we're just looking at corn as sort of that keystone commodity in US ag production and how that reacts to inflation. Obviously, there's market impacts that can drive runs in prices. Certainly more biofuels driving prices here through this 2007 through 2012, 13 kind of range. And then we've lined this up against almonds, which almonds tend to be a less reactionary to inflation. We did not see the run in this latest inflationary period. And what you see with almonds is a little bit more of a standard price cycle that tends to run about a 9-year price cycle. Things like inflation and other market dynamics can impact the scale of these curves in the cycle. And we are running just a little bit on a delay, but right in as we move into 24 and 25. But we are seeing prices in almonds start to rebound after a fairly compressed period. So I think the key takeaway and the key theme here is, yes, farmland is the premier real asset inflation hedge. But if that's a core part of an investment thesis in using farmland in a portfolio, we need to consider how that plays out. And we need to think about the production systems, the regions, and how we deploy that capital to meet that objective. This is a lot of data. So what we're looking at here is this sort of 30-year trend line by region. And the core takeaway, the core theme is as we moved into 2024, we were above trend line in every region in the country. Now, the scale of that move above trend line is a little bit different by region. And again, it comes back to how do those individual production systems react to some of those inflationary pressures. But we're seeing that correction back to that trend line as inflation is pulled back and as just the market dynamics and the incomes across all of these production systems are correcting themselves. And there's some pretty interesting dynamics in terms of the ownership as we look across these regions that we'll explore just a little bit more as we go through here. So let's take a look at what the income projections and forecasts look like. And this is a difficult game right now, considering the wide range of different kinds of impacts that will drive crop prices, particularly our large scale commodities. And we'll talk about some of that uncertainty as well. First thing, let's just get a little bit of perspective on what we produce in ag in the US. So we're looking at our top production categories of crops lined up with production value on the left bar and the acres to use to produce that value in the right bar. And when we talk about the farmland asset class in the US and we think about engaging it, corn and soybeans are the drivers, both in terms of acres and in terms of the total production value. And this is important in thinking about what farmland is and how to engage the asset class, considering that only about 1.5% to 2% of the total value is transacting on an annual basis. If we want to get capital deployed and we want to have exposure in the asset class, we have to recognize where we're able to get into transactional value. The fruit and tree nut category, much lower acres, but third in line in terms of the total production value. And this is heavily engaged by the institutional farmland ownership groups. And that's one of the things that we'll talk about looking forward as well. And then we move sort of down the categories of value. And certainly wheat is a lot of acres as well. In thinking about that ability to access the asset class. And then we put that out here on the map in terms of where this value is created. And we start to get honed in on key regions where we have an opportunity to really engage the asset class with capital. This is really informative in terms of giving us information about how to help get capital engaged in the asset class. So let's look at what the production forecasts are looking like. And these are some graphs and some data that's pulling together a number of USDA Economic Research Service projections. A group called Terrain has pulled this together. Here is a list of your primary row crops. We saw a lot of these crops in that top 10 production categories in that last graph. But here's where we're looking at what the cost of production is forecasted, and this is very much in a highly aggregated fashion across the entire country. So relative to pointing this to an individual region, and this will be true for some of the other data sets that we look at in just a second here, this is all pooled together, highly aggregated. So we'll see some interesting dynamics that pop out. So costs of production are generally going to be higher than 2021, but on a downward trend or fairly level as we go across all of these different crops. This is important when we come in and we start to look at what the price outlooks are. And this, I believe, is a pretty negative view of where the prices are going. Corn today is still in the 460 range on the December contract. So we've had some lift, some good exports. Mexico in particular has been utilizing a lot of corn and corn products to help with that price point. But generally speaking, a continued downward trend in these row crop commodities, with maybe a little bit of a boost in wheat as the only ag product here where we're seeing a forecasted increase in price. So we are down a little bit in cost of production. We see quite a bit of a downward trend in terms of the price points that are forecasted. And so this gives us a little bit of perspective on margin. And candidly, this is a little bit depressing as we sort of look across, because every single one of the commodities in this forecast are actually showing revenue estimates below the estimated cost of production. And we've seen that pressure, right? That's been sort of building out there. And again, this is going to be based on aggregate national level yields. So the $710 in revenue on corn certainly isn't necessarily going to be representative of some of the really high yielding areas. Of course, land cost is going to be a big factor in driving the cost of production potentially up higher in those scenarios also. So this is a pretty negative view. As I mentioned, I think we're not seeing quite as much price pressure in some of these key commodities. But the core message here in thinking about from a landowner perspective is that the operators are going to have some real cash flow pressures through this year. In talking with some bankers that we work with, by and large in the core corn belt, cash flow projections for 2025 are break even at best. Not a lot of cash flow projections for operators are coming through really positive. So this is some perspective that I think is important in thinking about how to structure relationships with operators on the land. And we're certainly seeing that in our land management and our asset management businesses. So when we put this together, here's the revenue shortfall projections using all of these numbers, again, in this highly aggregated form. But what we see is generally across all regions and all of these crops, we're going to be operating at a shortfall, and it's reasonably substantial. And I think that this is a little bit overly negative relative to what we're seeing some of the markets do right now. But again, there's a lot of uncertainty that is sitting out there in terms of what's going to happen, particularly from a trade perspective. So when we flip this back and we think about what happened on the farmland value trends across and into 2024, and we already saw a reduction in land appreciation rates versus those long-term averages, The moral of the story is with the partners we're working with, we're seeing some real acquisition opportunities emerge. So there's going to be opportunities to get into land that feels like it is at an excellent price point to be able to add to the portfolio. And we think it's an exciting time here coming into 2025, particularly for the buyers. Okay, let's bring this into some interesting dynamics at a crop level. And I want to use an apple example in particular. And we're going to talk about apples in Washington State. And this is where we actually see some interesting influences with the mix of farmland ownership. Okay, and so if we look at apples in Washington State, the estimates we've been hearing on total production from the state here in 2024 is about 138 million boxes of apples. The folks that we talked to that really manage the marketing side up there are saying that something in the range of about 115 to 120 million boxes is the right size relative to the markets that exist now. So if we think about the makeup of that market, you know, something in the range of 80 to 90 million boxes are going to be used domestically, with another 10 to 15 million boxes being really reliable trade partners, like here in North America, Mexico, and Canada. And then the bulk of that, the remaining chunk, is, you know, really Pacific Rim kinds of trade, which is potentially, from a geopolitical standpoint, a volatile market. So when we look at what's going on in the Apple space, there's been quite a bit of excitement just in terms of, hey, we can get into producing orchards at prices that may be half or less of a replacement cost. But the fundamental reality is that something in the range of about 20,000 acres of apples in Washington have to actually come out of production in order to get that market right sized. And that's assuming that the chunk of that production that's going to exports that are potentially geopolitically volatile maintains. So the moral of the story here is, as we look at specific crops and specific production systems, these dynamics will have quite a bit of variability and quite a bit of nuance in terms of what's impacting it. And one of the key stories on the Apple side is the ownership story. So let's talk just a little bit about farmland ownership. And thinking about the institutional impact of farmland ownership, there's a lot of data here. We're going to use the National Council of Real Estate Investment Fiduciaries, which is many institutional farmland owners that report their data. This is their breakdown of regions, just to give that spatial context when we're talking about different regions and referencing the table here, where this data is coming from. So NCREIF has about $16.35 billion in assets across the country. So very small relative to that total size of a $4 trillion asset class. But this is a great data source to give us perspective on where institutional capital has been deploying into the asset class. And what we've done here is look at some of the USDA data in terms of planted and bearing acres. We also have characterized sort of the value produced by region. And then we use that same USDA data in terms of land values against these planted and bearing acres in order to identify how much value we have by region. So the Corn Belt and the Northern Plains, just because of sheer volume of acres, clearly dominates in terms of the total value that's out there and identified here. And then we can look at where these institutional investors have actually deployed their capital. Okay, and we can see really the Pacific West and the Delta kind of dominate in terms of where that value's gone. And we can put that as a percentage of the value identified through this simple math that we've done over here using the NAS data. And in a place like the Corn Belt, the share of value is incredibly low, gets quite a bit higher in the Delta region, and then quite a bit higher in the Pacific West also. And the Pacific Northwest has been a region that they've been active in as well. And then if we think about 2% of that total value transacting, we can see where those transactions are. And now, how much value does the NCREIF Institutional Investment Group have compared to that transacting value? Okay, when we pop out and look at this, what we see is where is there actually substantial institutional impact in the asset class? And the Pacific West, Pacific Northwest, and Delta are the regions where they're having a significant influence. And this ties back to that example in the apples, because institutional capital certainly played a role in building up that apple production beyond where the market could support. And when we see that pullback to where we're at now, one of the sort of taglines that we'll throw out there is in those sort of drawdown and pullback periods, like we're seeing in apples, the folks that will continue to participate are the ones that are really committed to those production systems. They have businesses that are tied to that production system, and they'll work through this. And the institutional capital is going to be much more focused on the financial returns, and that's where we'll see an interest, sort of an interesting retrade in terms of who's owning in those regions and production systems. So I'd point you to the website. Steve Brewer put together an interesting white paper on the evolution of farmland as an institutional asset. And we're seeing the ownership dynamic shift. That's why we want to talk about this just a little bit and how this capital is participating. And so just a little bit of a quick timeline on how this played out. So we had coming out of the farm crisis, where we had a pretty substantial drawdown in farmland values. We started to see some early engagement from institutional investors. And this kind of moved along in, there was a limited set of sort of formal programs for acquiring and managing farmland from an institutional standpoint. And then the financial crisis popped through here in 2008, and a couple of outcomes. We had very low fixed income returns from an investment standpoint. And then there was a lot of appeal to assets, particularly real assets that have that negative correlation with public equities, which certainly farmland fits the bill. So farmland being a fairly low cap rate, fairly low annual return asset class, with that majority of the return coming from that long-term appreciation. The fact that fixed income returns were low and we got that negative correlation really triggered a lot of emergence of business models that kind of came around primarily in institutional funds. And we saw a substantial amount of capital move into this arena in formal asset management business models from 2010 through 2014 range. And a lot of them were in that sort of 10-year life cycle in terms of the fund life. And so starting in 2021, which did tie to this latest inflationary period, we started to see some end of life and assets trading hands. And there were a lot of successful exits where we had that run in asset values. But there's a flip side to this with the inflationary run. Now there's fixed income returns that are substantially higher than when a lot of these funds are initially emerged. And so that exposure into farmland, farmland just simply isn't quite as competitive when you can go get a 5 or 6% yield just in a treasury or in various other sort of fixed income bond style outcomes. And so there's been quite a few challenges with a lot of these institutional groups raising capital and trying to get it redeployed into farmland. So we are seeing interesting dynamics in terms of the capital stack that's going to be working in the asset class. The other part of the transition that gets pretty interesting is thinking about the demographics. And folks have been talking about the demographics of farmland ownership for a long, long time. And generally speaking, it's been highly skewed into older ownership in farmland, but we've seen a lot of generational transfer as we move through those demographic cycles. We do think that this is starting to shift a little bit. And Iowa State puts out their land tenure survey every 5 years. And this is really good data. Certainly, Iowa isn't necessarily representative of what's happening in other regions in the country, but the perspective is pretty valuable. We're up to over or at 86% of farmland is owned by somebody 55 or older. And that creates a perspective on about 30 years that we're going to have quite a bit of turnover, and that generational cycle seems to be sort of breaking to a certain degree. Perhaps it transfers, gets the stepped up basis, and then transacts. In many cases, we're seeing scenarios where the farmland's transacting even before it gets handed down generationally. It's also noteworthy when we start thinking about the ownership dynamics across different crops and production systems. When we get into our cash grains, we see a high percent of the farmland that is operated under a lease, right? So this gives some perspective on where turnover is going to be a little bit more aggressive. So if we make some really simple assumptions around 1.5% of the asset class turns over, and we say we're going to continue to operate at a trend of a 5% appreciation annually, what we see is there's going to be over $4 trillion in land change hands over the next 30 years. If we say that the demographics are actually going to accelerate that turnover to 3%, then we'll be at almost $8.5 trillion worth of farmland that'll change hands over the next 30 years. So this is another sort of front end of the demographic transition when we put that together with the reality of a different sort of scale and a different sort of nature of institutional participation, where we're thinking that 2025 we start to have some interesting dynamics emerge in terms of ownership and who's transacting the farmland. Another piece that is also getting pretty interesting is the engagement of retail capital. And what we see within this retail space is they generally have not had, this group of investors has generally not had a lot of access to farmland. Certainly there's real estate investment trusts, a couple of publicly traded REITs, Farmland Partners and Gladstone that are out there. That is a public equity, so it's a little bit different approach to engaging farmland. There are some funds that can work in the retail kind of category, but for a lot of investors, access to the funds can potentially be at entry points that aren't quite achievable. Direct ownership is pretty hard. That requires quite a bit of capital, and then it requires the expertise or the ability to engage farmland professionals to support. And at a retail level, that can be a challenge, certainly. We are seeing the emergence of the fractional ownership platforms, think Acre Trader and Farm Together, which are creating additional access for retail capital. We continue to see that trend emerging, right? The asset class is an incredible investment opportunity for anybody. Of course, we're biased in saying it's the best, greatest asset class on the planet, but there are certainly a lot of characteristics that should be a part of about anybody's portfolio. And when we look at the scale of this retail investment capital at over 100 trillion, just a little bit of participation and a little bit of growth in the engagement, this could be really impactful for how the asset class transacts going forward. Okay, we've talked quite a bit about how we are looking at revenue streams on farmland continuing to evolve and emerge. Certainly, the political environment is a lot different now than it was even a year ago around the energy transition and the emergence of renewables within the asset class. With that said, we also are seeing some really interesting dynamics from just a raw engineering perspective on solar. On a personal level, I've always struggled with, does it really make sense to put solar panels over some of the highest valued, most productive farmland in the world? And that's a debate that's certainly open for folks to consider. But the raw economics of solar in particular are starting to become pretty compelling. We had a breakout session at the Land Expo for folks that were registered and weren't able to actually attend that, or that are interested, where we kind of got into the business models a little bit on solar. The engineering is emerging in a way where we're seeing really compelling economics, even with some discounts to how that farmland may appreciate over a 40-year lease. Uh, we're starting to see this play out in a way that we think it could be impactful outside of subsidy environments. And we'll continue to dig into that solar story here over the course of this year, because it's going to be fairly dynamic. And a lot of folks that are listening have potentially seen some pretty compelling offers in terms of development around the solar side in particular. So we think that can have some legs and some traction, even outside of some of the policy kinds of impacts. The other one that's getting pretty interesting for us, and we're going to be working on developing more over the course of this year, is how private ecosystem service business models can potentially emerge. And when we talk about ecosystem services, it's useful to grab a little bit more perspective on what we mean. So in agriculture, we've also always been very practical, right? The creation of value has been those food, feed, fiber, fuel products, the provisioning services that we create, and that's driven everything we've done in developing the industry. Farmland also provides regulating services in terms of clean water, in terms of the carbon cycle, in terms of just the interacting with the surroundings, with the environment around it, and then supporting services and cultural services as well. When you look at some academic studies estimating the value, you can get to some astonishing numbers in terms of how much farmland and land in general is actually doing from an economic standpoint, and the capital that it provides to the broader sort of global ecosystem. And when we start to look at where in the country farmland is pretty dominant in terms of acres, in terms of coverage of the land, we see areas where these regulating and supporting services, and also the cultural, can be pretty impactful relative to the total value add within those particular regions. And so ecosystem service valuation right now, and we can realize revenue from a lot of different kinds of programs. They're very fragmented, and that requires a lot of work relative to the value that's created. Here's a simple example of how this might play out in today's world, and putting these sort of fragmented programs together. So this is a simple corn belt, 160 acres with 150 tillable. So we've got some non-tillable acres that are available for some of these services. And here's some examples of how we might put programs together. The Conservation Stewardship Program, which is a farm operator program, this is important to recognize. We can stack together enhancements in this program, looking at nutrient management, integrated pest management. Maybe we're reducing tillage, and maybe we're using cover crops, and getting something in the range of a $50 an acre payment. There are programs with some carbon markets. We've seen a lot of drawback in these programs, and as a lot of folks have had experience with, the payment is challenging, right? We have the issues of additionality and permanence in carbon markets. How much am I really adding to the soil? And the fact that it's just not permanent, it can be released again. So we see those discount factors, programs in the range of maybe $20 an acre for utilizing those no-till and cover crop types of practices are pretty common. We're also seeing programs with consumer packaged goods companies that will leverage a lot of the same practice concepts that we've already talked about. And this can create some per acre payments or perhaps some additional incentives for the products that come out, and think in the range of another $30 an acre. And then we may have a recreation lease opportunity. We'll call that hunting lease, hunting rights sold at $10 an acre. When we put this all together, we're looking at a little over $100 an acre, $16,600 total across all of these acres. And if we make the assumption that all of that value goes back to the landowner, and this farm asset is at a 3% cap rate, that's about $3,500 in additional value. So this is significant, but it's difficult and it's highly fragmented. These programs aren't permanent. One of the things that we've gotten really interested in is the notion of a natural asset company. And we're working with a group called Intrinsic Exchange that are building these NACs. And this is a little bit of a concept we'll be exploring in a pretty big way as we look forward through 2025. But natural capital accounting is a construct by which we're creating recognition of the economic value of all of these additional services provided by our farmland. And then what the concept of a NAC does, a natural asset company, is do the analysis on what that inherent and potential natural asset value through the accounting processes look like for a farmland asset. You can aggregate assets and then license the rights to the ecosystem services, kind of like you would think about licensing mineral rights. And then now you raise capital through those licensed rights, and you can invest that capital. You create a market. You create a real market where these consumer packaged goods companies can engage, or other investors from any number of different perspectives can engage. That capital gets invested into structural practices, maybe regenerative or restorative kinds of transitions. And then that creates additional value over time. This is interesting to us in the context of creating a marketplace by which people can engage in at scale. Lots of interesting kinds of challenges to sort of work through and get characterized. But this is a privately funded model that we're at least interested in getting our arms wrapped around as a mechanism by which to really realize value going forward. So want to close out here with just a couple of the key uncertainty factors as we think about these things playing out into 2025. And none of this is going to be a surprise, right? It's what everybody around the industry is talking about, right? What's going to happen with tariffs and the strength of the dollar relative to our trade markets. And we're seeing pretty strong trade, particularly as I mentioned before, Mexico with corn right now, that are supporting prices. But we don't have much clarity on exactly how that's going to play out over the course of 2025. When we talk about sentiment and equity markets, we have conversations on a fairly regular basis with folks that are ready to take some gains in public equities, withdraw and move to more of an inflation hedge asset with really strong fixed returns over time, i.e. farmland. And so there's going to be, in our view, a lot of capital that's going to say it's time to pull out of public equities with this incredible run that's happened, and start to move into a more stable asset and think about the capital gains side through farmland, particularly as an inflation hedge. There's a number of folks that we talk to, and we'll share the perspective to a certain degree that the inflationary trend is certainly not completely over yet. And I heard a very interesting statistic. So if you aggregate the total value of all public equity markets across the globe, 70% of the capital has moved into US public equities, where the US GDP is only 28% of the global GDP. So the US markets are flush, public equity markets are flush with global capital right now. And there's a lot of folks that feel like that has some characteristics of, I'll use the phrase a bubble to a certain degree. The cost of capital is going to continue to be really impactful. Where does that cost of capital continue to move? How does inflation continue to work? And as we think about the ownership dynamic shifting potentially a little bit, this will have quite a bit of impact on land value. How much can buyers, particularly owner operators, capitalize from a debt standpoint? The renewable energy policy story will continue to play out and be quite impactful as we think about a lot of these development contracts that are in place and what hurdles are put in place or what incentives are changed. These things will be pretty impactful. We got a kick the can extension on the Farm Bill. So that conversation is going to come back around, and it'll be really interesting to see how cost-cutting measures at a federal level could potentially be impactful to the Farm Bill. We just don't know. There's a lot of uncertainty there. And then the private movement of ecosystem service business models, right? Outside of a lot of publicly funded programs. This is more of a long-term theme in our view, but it's certainly one that we have our eyes on and we'll be watching as we go into 2025. When it all comes back around, we still maintain that there's a core set of principles that are going to be successful in farmland investing, and this is not going to change, right? If you focus on high-quality assets in competitive production regions, where the farmland is part of creating that community value, places that people want to live, and the farmland's part of building wealth, we will get that long-term appreciation and the assets will perform over time. So the core principles haven't changed. We've covered a lot of nuance in terms of dynamics that we kind of know are going to have some impacts and create some opportunities. And then also several things that kind of aren't completely known yet that can still potentially impact how the asset class moves forward here in 2025. So I thank everybody for joining. We'll be back here in a couple months to dig into some additional topics, and feel free to send me an email with any questions, dave.muth, M-U-T-H, at peoplescompany.com, and look forward to having some additional insights webinars with you going forward through the year. Thank you very much.